Hello students, welcome. This is Dr. Chetna Kumawat and today we are going to start a new chapter which is financial planning and forecasting. In this chapter, we will understand meaning and nature of financial planning, characteristics of a sound financial plan, factors affecting financial planning, significance and limitations of financial planning, estimating financial requirements, sources of finance, financial forecasting, utility and significance of financial forecasting, and some important techniques. Capital is the lifeblood of a business. No business, however small it may be, can be carried on successfully without proper management of capital. Since incorporation of a business, funds are invariably required of and on to carry on various activities of the firm. It is, therefore, the duty and responsibility of the finance manager to plan the inflows and outflows of cash to make sure that funds are available at all times as and when they are required, so that the long-term and short-term objectives of the firm may be achieved and the interests of all concerned parties, owners or shareholders, creditors, employees, and public may be safeguarded. The future success or failure of the business depends on the sound financial planning. Forecasting of financial results is also a part of business planning. In it, management expresses the planning of activities of a particular period. In finance, keeping in view the competitive, technical, and social environment. The present chapter highlights the financial planning and forecasting in detail. First, we will take meaning and definition of financial planning. Planning is the process in which an enterprise tries to make the best possible use of its resources towards achieving its objectives. Financial planning means deciding in advance the financial activities to be carried on to achieve the basic objective of the firm. The basic objective of the firm is to earn maximum profits out of minimum efforts or to maximize the wealth of the shareholders in efficient manner. So, the basic purpose of financial planning is to make sure that adequate funds are raised at the minimum cost and these funds are used wisely. As such, financial planning may be defined as a process of decision making regarding determination of the firm's financial objectives, financial policies, and financial procedures to deal with its financial activities. In this context, financial planning pertains only to the function of finance and includes the determination of the firm's financial objectives, formulating and promulgating financial policies, and developing financial procedures to ensure the optimum use of financial resources or capital. Nature or components of financial planning. It consists of following activities. 1. Determining financial objectives. 2. Formulating financial policies. 3. Developing financial procedures. Author as doing has incorporated the following activities in financial planning: estimation of capital required, that is, determination of capitalization, determination of different sources of capital and securities, mix, that is, capital structure, and proper policies for administration and management of capital. Now, let's take a look on objectives of financial planning. The main objective of financial management is maximization of shareholders' value. This corporate's objective can be achieved only if the resources of the enterprises are profitably employed. From the above study, we can enlist the objectives of financial planning as follows: 1. Provision of adequate funds. 2. Procurement of funds at the minimum cost. 3. Balancing of costs with risks. 4. Provision of an element of flexibility. And fifth, ensuring simplicity of financial planning, so that there is consistency among various objectives of the enterprise. This objective can be achieved best if a proper balance is maintained between short term and long term funds, and the types of securities issued are minimum. Types of financial planning. On the basis of time period, financial plans may be divided into the following categories. 1. Long-term or long-range financial planning. Generally, financial plans formulated for more than 5 years period are called long-term financial plans. These plans reflect the impact of long-term investment and financing decisions on the financial position of the firm. These plans focus attention on aspects such as capital expenditure decision, research and development expenditure, product development decision, and long-term financing decisions. 2. Medium-term financial planning. Financial plans formulated for the period of 1 to 5 years period are known as medium-term financial plans. The objective of such plans is to search such sources of capital whose cost of capital is the minimum and elasticity in capital structure remains intact. These plans are prepared for replacement, maintenance of assets, continuing short-term production programs, and meeting the requirements of working capital. And lastly, short-term financial planning. These plans usually cover a period of 1 year and deal with the implication of short-term decisions. The short-term financial plans are helpful in meeting the short-term financial requirements of the firm, balancing the cash flow so that the firm may not face any difficulty. Various types of budgets and projected profit and loss account and balance sheet are main instrument of such plans. Now let's understand the process or steps in financial planning. The financial planning is a complex exercise involving almost every aspect of functioning and operations of a firm. It has to incorporate the future uncertainties while formulating the plans, though the basic elements of a financial plan will be similar irrespective of the size and nature of different firms. Even then, the following steps may be taken while formulating financial plans. Number 1. Historical analysis. The past performance of the firm must be analyzed to identify the factors and variables contributing to the present position. For example, analysis of profit and loss account for last few years may indicate 1. What has been the growth in sales of the firm. 2. What has been the profitability and trend of various expenses of the firm, both in absolute term as well as percentage of sales. In case of a new firm where the past record is not available, the past performance of some other existing firms may be considered. Number 2. Identifying the long-term needs. In the light of the growth strategies of the firm, an investment plan should be charted out. How much funds will be required to implement the plan? When the funds so required are to be raised, the total requirements and timings of raising these funds should be planned. All these depend on the capital budgeting decisions. Number 3. Identifying the sources of the funds. The long-term requirements of funds are to be met by arranging funds from different sources. This planning requires to keep in view of the target capital structure of the firm. Internal accruals and plugging back of profits are to be considered. Fourth, analysis of the operational activities. The operational activities of the firm are to be analyzed to identify the expected revenue and expenses of the firm. The operational activities include all working activities such as sales, production, marketing, inventories, and etc. Lastly, harmony among different plans. All types of strategies and planning should be harmonized within the financial planning. For instance, there should be a complete comparability among the sales plan, production plans, marketing plans, and inventory plans. There should not be any confrontation among these plans. After understanding the process or steps in financial planning, let's jump into the characteristics of a sound financial plan. The success of a business enterprise depends to a great extent upon sound financial planning. A sound financial plan facilitates a coordinated approach to financial policies and procedures. It guides in decision making in the area of financial management. A financial plan is said to be sound only when it contains the following features. 1. Simplicity. A sound financial plan should be free from ambiguity and complexity so that it is easy to understand and simple to manage. 2. Foresightedness. Foresight and vision are essential to estimate the amount of funds required. Hence, financial plan needs to be drafted after estimating the present as well as future financial requirements of the firm through accurate forecasting. 3. Optimum use of funds. Effective utilization of capital is as much important as the procurement of adequate funds. This requires the fair capitalization as well as a proper balance between the fixed capital and working capital. 4th, flexibility. The financial plan should be flexible enough to make necessary adjustments in the height of changing circumstances. Hence, the financial structure should be such that the company can finance its expansion and modernization programs easily. 5th, liquidity. Liquidity means that a reasonable percentage of current assets must be kept in the form of cash so that business operation may be carried on smoothly without any shock due to shortage of funds. 6th, provision for contingency. A good financial plan has adequate provisions for business oscillations and anticipated contingencies such as prosperity and depressions. In depression period, it is very difficult for a company even to procure the minimum amount of working capital. Investors would like to invest in fixed income securities and not in equities. Therefore, adequate provision should be made in the financial plan for possible contingencies. And lastly, economy. The cost of raising capital, that is various expenses relevant to issue of capital such as underwriting commission, brokerage, printing, advertisement, should be minimum. The financial plan should be such that the payment of fixed charges is not too burdensome on the firm's earning. Therefore, the mix of securities should be so devised as to create a proper balance between the cost of funds and the firm's ability to pay. Before working on a financial plan, one should also understand factors affecting financial planning. The financial plan is formulated with a view to procure sufficient amount of capital at minimum cost and establishment of effective coordination between costs and risks. The plan to be formulated for achieving these objectives is affected by a number of factors. Such factors as given below should be taken into consideration while formulating the financial plans. 1. Nature of industry. 2. Size of business unit. 3. Quantum of risk. 4. Appraisal of alternative sources of finance. 5th. Attitude of management. 6th. Statutory control. 7th. Some external factors like money market conditions, views of investors, tax policy of government, and normal level of interest rates. All these factors are very important and should be given due consideration before finalizing the financial plan. So this is it for today's lecture. Thank you so much for your patience and learning.